So yes, I'll be joined by my colleague Andrew McMillan, who heads up our gaming and gaming technologies offering within Johnston Carmichael. He is a tax partner, works in and heads up our innovation taxes offering here at Johnston Carmichael, which help companies with the R&D tax relief, patent box and other creative sector reliefs, including video games tax relief, VJEC, etc. So between the two of us, we have pretty much most bases covered, but a lot of what we'll cover today has been, like I said to Helen at the start, what we've been assisting our clients understand since the 30th of October when the budget was announced. So what we're planning to cover today is essentially go through a corporate tax or business tax update. Then we'll go into some of the reliefs and some of the specialist taxes. And then we'll talk about the update for a bit of an update for individuals. What does this budget mean for whether that be you as a founder or whether that be you as an employee of a company or a business? And then, like Helen says, we've got absolutely loads of time built in for questions. If anyone wants to put a question into the Q&A box, please do so. Otherwise, happy to have a Q&A session at the end. I will caveat and say, obviously, everyone's scenario is slightly different, so we will try to cover off as much as we can in general terms, but if anyone has any specific questions that they'd like to ask, then happy to also do that separately and follow up if they'd rather do it that way. Excellent. Okay, so thought it would be useful just giving some context to budgets and tax. So in the UK, we typically have an annual budget. However, I think pretty much since 2020, since COVID, we've been having 2 a year. So we've had the main budget and then an autumn statement, or we've been having a spring statement with an autumn budget. But the indication is that will go back to annual from this point on. But as to when that will land, we're not entirely sure. So why do we do budgets, or why does the government do budgets? Well, the purpose of that is essentially to outline the spending commitments for each department of government and the devolved administrations. So for gaming technologies, we're particularly interested in the line that is DCMS to understand what impact there is for that. So I'm pleased to say that in the latest budget, there was what appears to be a 2.6 real-term increase in spending for DCMS, which is fantastic. But I will say that the majority of that appears to be allocated to capital funds. So what does that mean? That means the day-to-day spending of DCMS hasn't gone up substantially. It's went up by around 100 million of 2.3 billion. So a relatively low percentage, but the majority of the increase of that 2.6% has gone to capex. So we could, and DCMS covers areas such as sport, theatre, other creative sectors as well. So it's likely that any form of building refurbishment, all that will be covered by the capex. But we're really pleased to say that this fund hasn't actually went down, which I think was one of the concerns that was being aired pre-budget. So that was good news. And another, I guess, beacon of hope is that within the government's the UK government's modern industrial strategy, the creative sectors are identified as one of the 8 key pillars of growth. So that's a really great sign to show that the government are paying attention to what the creative sector is doing, what we're trying to achieve, and recognising that and in the role that gaming and gaming technology has in the future growth of the UK economy. And as I say there, the most recent budget was just a few weeks ago there on the 30th of October. And that essentially outlined two changes. Essentially, one is a raft of measures that will come in from the 6th of April 25, which we will cover, and a lot of them are instant, immediate, that will have taken effect from that day. And we'll outline the difference between the two when we're going through this. Every budget that is put out there has macro and micro impacts across the whole of society. So the micro impacts are the impacts that are felt on every individual in a day-to-day life. So we will be going through in that update to the individual section. What does that mean on a day-to-day expenditure? How much tax you as a sole person or a sole business are going to have to pay. The other side, the macro side, is how much government borrowing are we doing, and what do the markets think of the budget and the reaction of that? And there was a lot of media surrounding the 24, 48 hours after the budget where the UK's rate of borrowing was going up because the markets weren't entirely sure or convinced about the budget, but with some reassurance from the Chancellor following some media rounds and further analysis, the markets have now settled, which is good to see. The next budget, like I say, that is due to land at some point next year, but whether that will fall in spring or autumn, we will see. And then one key point is this was a UK budget delivered from Westminster. With devolution that's been in place from the late 1990s, every administration across the UK will have a devolved budget as well. So I'm currently based in our Dundee office. So the Scottish budget, for instance, is due to come up on the 4th of December. So it keeps me and Andrew busy because we know once one budget's done, there's always going to be another one to quickly follow up on. So yeah, we will look to see. So some of these impacts we'll be covering today are for UK measures, and there will be some subsequent updates that will be issued after the Scottish budget, the Welsh budget, and now that Stormont is sitting, hopefully we will start to see some budgets coming out in Northern Ireland as well. Okay, so the tax landscape. So we're going to cover two main areas of tax, and like I say, we're going to cover the personal tax side of things. So there's three main taxes that individuals suffer or incur in their day-to-day life, which are income tax. So that's the money that you will pay if you're self-employed or whether you're employed by a company. How that's taken out is determined by whether you're employed or not, but you will suffer income tax. National insurances, so that's where you make contributions towards your national insurance, which is pensions, your healthcare, etc., etc. So again, that will vary between whether that is a private individual that's going to suffer that via their self-assessment tax return, or whether they'll suffer that at source, similarly linked to their employment status or not. And then capital gains tax. So that is where a private individual will make a gain on an asset that they've disposed, and then they'll pay some capital gains tax again through the self-assessment tax return. Graham, I notice you've got your hand up. Can I maybe get you to put your observation in the chat or a question in the chat, and then I'll pick that up as we're going through, if that's okay. Thank you. So business tax, I'll jump onto that, and we'll say that there's three main areas again that we're going to look at today, which is around the corporation tax side of things, employer taxes, so that's where the employer has to pay their contribution. And then there are some reliefs, and I've mentioned that Andrew, my colleague who's on the call, will chat through some of those reliefs. I will highlight there are other taxes and duties that were included in the budget, but we feel like for this forum, these are the main taxes that we'll need to cover. So I'm going to jump straight into business tax. And we're going to start with the moneymaker. Unfortunately, not for employers, and this is the biggest area that the government looked to raise money in the latest budget on, which was through employer national insurance contributions. So as you'll see on the slide there, effective from April 2025, employers will pay 15% employers national insurance contributions, which is a 1.2% increase from the current year. So that was probably lower than what we were anticipating. There was speculation around it going to between 15 and 16%. So to be at the lower end was probably relatively good news from what was being discussed in the media prior to the budget. But what was less trailed about was around this per employee threshold. So that has reduced now from £9,100 to £5,000. So what does that mean? That means that any studio that or any business that is employing individuals with a salary of more than, in the current year, 9,100 will start to pay national insurance contributions as an employer. But what will happen from April 2025 is that limit of 9,100 will go down to £5,000. So effectively, you will be paying more tax earlier in that employee's salary. So that will have a material impact to a lot of businesses, and I've outlined there. So if an employee was, say, a part-time employee on £9,100, then the cost of that additional, the cost of these measures will now cost the business around £600 per employee on that rate. But if the employee is on £35,000, then the additional cost is going to be around £925 per employee. We'll go into an example in a minute about what that actually means, but just to give some high-level numbers around that. On the flip side, the good news was that the employment allowance, so the FSB, the Federation of Small Businesses, have been canvassing for many years for this allowance to be increased. So that is that the first £5,000 of national insurance contributions paid by the employer will be covered by this employment allowance. Now, there are various eligibility criteria, and I'd always suggest you check that you do qualify for that. But if you do, then the first £5,000 of employer NICs are covered. That will be going up by more than double to £10,500. And if you're at the very, very top end, there used to be a cap whereby if you had £100,000 of employer NICs, then you wouldn't be eligible to claim it. But now that's been removed. So basically, any company that is employing individuals and qualifies, irrespective of whether you're, 5 employees or 500 employees with more than £100,000 of employers NICs, can benefit from this employment allowance. Some other things to watch out for. So obviously lots of these things were announced by Rachel Reeves in the budget, and then subsequent to that there's all the kind of briefings, the budget analysis goes on. So there's a few things just to watch out for haven't quite landed yet. So there is currently a review ongoing on the eligibility criteria of employment allowance. So that's one just to watch out for. And there's also a review of absence and family related payments. So again, watch this space. I'm sure our payroll team and employer services team will be sending out various updates on what we have learned. We expect that will settle around the early part of 2025, so that there's enough time for that to be implemented by April 2025. But I think there's links to socials and so on later on. So please do just follow our socials, and we'll update when we get more clarity over that. And one thing that was also touted ahead of the budget was there was anticipation that there was going to be some impact on the employer pension contributions, and we were. It's good to see that these were unaffected by the budget. So what does this mean, and what can I do? So one thing to say there is essentially that you need to understand the likely impact for you and your business if you're a founder. Everyone's situation will be different. So therefore, I think the last point is relevant there, engaging with your payroll bureau, tax advisor, accountant, whoever you've got in your team, just so that you have an idea of what effects this will have when it all kicks in from April 2025. Across if I took a holistic view on this, then some micro businesses, so organizations of 1 to maybe 3 or 4 members of staff might actually be slightly better off with this. Like I mentioned, the employment allowance going up, that might actually cover a lot of the increases, so they might be better off for this than what they were. But it's likely that most organisations with more than 5 employees will probably be slightly worse off. But again, that depends on the dynamic of the salaries that you've got in the organisation. Yeah, every situation is different. So please do just work through that and figure out what that means for your business. So I've got an illustrative example which should hopefully assist if the slides kick on and go to illustrate this point. So I've got a gaming studio based in Guildford. It's got 10 employees with the median salary is around 35,000 in the UK. So I've just taken that as I appreciate certain salaries in gaming studios are perhaps not as strong as that. Some might be, but I've just taken the UK median salary, which is £35,000. So 10 employees, and they also operate an auto-enrolment pension scheme as required. So based on the numbers here, as you'll see, in the current year, 24-25, which is the period we're in just now, the annual salary for that, gross salaries will be £350,000. If I put on the employer pension contributions of 3%, that costs around £8,600. The employer's NICs on top of that will then be an additional £35,700. And at the moment, like I say, you benefit from a £5,000 employment allowance. So the total cost of employment to this company is just shy of £390,000. 389,370. If I roll forward the clocks and take the exact same scenario, i.e. there's no wage growth and we just continue on the same basis, then you'll see that, okay, salaries and employer pensions will stay the same as indicated, but the employer's NIC will be increasing. That's increasing to just shy of 45,000 in this scenario, but that is compensated by the additional employment allowance there of £5,500 compared to previously. So the cost of employment in this scenario from April is going to be £393,000. So that's an additional cost of around £4,000. Now, what I've then done is taken the same kind of scenario and doubled the studio size in terms of employees, and you can see how quickly the cost of this rises. So for another 10 people, that's going to cost the organisation £13,000. So you can see very quickly by the companies that are employing a lot of people will be paying a lot of additional employers next, whereas the micro smaller businesses will have slightly less, but I appreciate at that stage £4,000 is still a lot of money. So what can I do to mitigate the impact of that or manage that? So I think one thing that we've been advising a lot of our clients on is having a deep dive of your finance function and see whether you're taking full advantage of schemes such as salary sacrifice. With the increase in national insurance contributions, by having a salary sacrifice scheme in place will save both the employee and the employer in terms of national insurance contributions. So if I take a step back, what is a salary sacrifice scheme? That is whereby there is some benefit provided to the employee, whether that be their pension or there are some other incentives out there that can attract a salary sacrifice scheme. So what would happen in the scenario before, instead of the employee getting a £35,000 salary, if you had a pension that's 10% pension, just for ease of a number, that was salary sacrifice, instead of 35, then their salary would be taxed at £31,500, i.e. 10% off that top level. So and like I say, that then has an impact both for the employee and the employer in terms of national insurance contribution savings. So it's definitely worthwhile having a look at those sorts of schemes if you've not got them in place already. Other wider benefits. So one thing that we are expecting to see as a result of this is less salary growth because the cost of the employer is going to be higher. So it may well be that you need to think of other ways to keep your employees engaged with your organisation. So you may be looking at wider benefits that are subject to PAYE, and there are some there that are not subject to national insurance contributions. Again, speak to your tax advisor around what those might look like for you, your organisation. But definitely look at the whole package that you're offering your employees, as there might well be something smart you can do in there. Just put a little comment in there saying watch out for mandatory payrolling. So what does that mean? So that is whereby benefits at the moment that are provided to employees are either declared via P11D return, which is once a year. Every year you submit a form to say, Joe Smith has received this benefit this year, and you declare that benefit and you pay the relevant additional tax that comes from that. Going forward from April 2026, that will be built in as part of the payroll reporting. So what that's essentially doing is speeding up the tax collection and payment of that, so that it then is included within the payrolling of the company. And that comes in from 26, not 25, but just one to watch out for, to make sure you build that into your systems. And then the final thing I've put there is around attracting and retaining business critical staff. So, for instance, we see a lot of businesses using EMI options, CSOP, other forms of employee incentive program, whereby they may well be given options to the company going forward, so they own a little bit of the growth that the company will have going forward. And employee ownership is very much still, particularly in Scotland, but across the UK, very much seen to be a good thing, and that those ambitions are very much here to stay, and the schemes that support that are very much here to stay. So very much worthwhile looking at if you're looking at succession, bringing that management team with you to ensure that, or if you're bringing key members of talent in to grow, then that might be a really neat way to manage any tax liabilities, but still remunerate them in a positive way. One thing to watch out for is the national minimum wage. So that went up for over 21s by 6.7%. Now that's was expected. What probably wasn't expected was the level of increase on the more junior members of staff, including apprentices. So we are seeing a lot of pushback or feedback going into government around certain sectors, for instance, food and drink, hospitality, and certain studios will have members of staff who hit these age brackets as well. So just something to watch out for is this making sure that you meet the national minimum wage legislation. And one thing to say there is, I obviously mentioned salary sacrifice. One of the risks is by reducing the salary sacrifice, if someone is already close to the national minimum wage, then they can't go below that. So you need to manage that effectively. So just one really technical point, just make sure that you, after salary sacrifice, don't go below any of these rates. And we've had a couple of scenarios where we've helped clients manage that going forward. So we've got a plan in place from April 2025. Okay, and then the final point on there is just to make the wider point that with this significant increase of 7% for those organisations that do employ people on national minimum wage, and if they employ a lot of people, then it is likely that they're going to have the burden not only of this 7% increase, but also the national insurance employer increase as well. So they are going to have a significantly higher bill that needs forecasted and planned for. Okay, so I'm going to jump into corporate tax now, and basically there were certain conditions that were outlined when Labour were vying to get into government, and they did various showcase events and pitching to business. What they were canvassing was trying to gauge businesses' opinion on what would help private sector investment, and they basically came up with these items, which are basically long-term commitments, predictability, stability, certainty. So I'll go into each one of them. So long-term commitments. So that is where the government indicates it over a longer period of time what they're trying to do. The predictability, there's no shocks. We're not dealing with a situation whereby today we're at 19 and 25%, we're going to jump to 30% flat rate. It's predictable about what we're going to do. Stability, again, that's just being not jolty and not having any surprises is the predictability. Having certainty will allow people to have confidence to invest when they know what the playing field is, and having an effective tax system. So this is something practices like ours have been pitching for many, many years, is having a tax system which is effective in the collection of taxes, whether that be by HMRC making sure that they're running effectively, or whether that be that the legislation and the guidance that goes with that is as clear as possible, so that businesses know what is the right amount of tax to pay. And by doing all that, we need to maintain that competitiveness for international investment, and that is a critical factor for any studio that's looking in the UK, where a lot of the funds will come from outside of the UK as well. So to address that, what they've done is they've put this publication of the corporation tax roadmap out. And some of the key outcomes of that is essentially outlining that the Labour government intends to cap the headline rate of corporation tax to 25% for this Parliament. Now, a Parliament typically will last 4 to 5 years. There was some commentary about whether they would go short or go long and so on, but we're a long way off that for just now. So based on previous, you could expect that to be the case for the next 4 to 5 years. Big caveat there, that if obviously there was a change in things, there is a budget every year, and this could change. Anything in the previous slides could change again in a year's time at the next budget. But they've indicated at this point that their roadmap, their intention is that headline rate of corporation tax will remain at 25%. They'll continue to monitor international developments to make sure that we are at a relatively competitive rate. I think I read somewhere we're the lowest in the G7, but obviously when you then expand that out to the G20, it's slightly less competitive. So that's something that they will monitor over time. And one good thing is that we understand that the small profit rates is here to stay as well, which is essentially for smaller companies with taxable profits up to £50,000 will attract a smaller corporation tax bill. They'll only pay at 19% for that first 50,000. But what that does mean is there is a marginal rate, which is essentially the rate that you're paying on every pound between 50,000 and 250,000 will be taxed at 26.5%. So I would always say there are opportunities there for you to review if you are making profits. And my colleague Andrew will cover some of those reliefs that are available to bring down those numbers. But looking just at your day-to-day, having relevant and timely management reporting will help you in managing that the most effectively in year, as well as engaging with firms like ours to see what we can do to relieve some of that profit. One final thing that's not on the slides, though, is just something around the associate company rules. And again, they haven't changed in the budget, but it's definitely something that we have been assisting our clients understand. That came in, I think it would have been 2 budgets ago, and only came in last year. So the associate company rules are essentially whereby you own or have a controlling interest in multiple different companies, and they interact with each other. they are essentially linked for the purposes of corporation tax. And if you have that sort of situation, then I would absolutely encourage you to get some professional advice around that and making sure that you're operating in a tax efficient manner. Last slide for me just now before I hand over to Andrew. Just some other smaller announcements that came out of the budget. So for those who are not paying their corporation tax on time, then the rate will increase by 1.5%. So again, rewarding those who pay their tax on time and penalising those who take longer. So definitely worthwhile building these tax liabilities into your cash flow to make sure you're not paying any undue interest. There's some further clarity and tightening of the rules of EOT, so that's employee ownership trusts and employee benefit trusts. This is where a company, there will be a trust that then owns a significant part of the company. This is the government's mission, because employee-owned companies tend to be or can be more productive. The benefits are still absolutely there. This was mainly around some anti-avoidance and tightening of rules there. Similarly, on the loans to participators, so that's where you perhaps as a director take some money out of the business and are due to pay that back at some point. There's been some tightening there around some anti-avoidance measures, and then just some final points then on tax administration about how they are going to be improving their HMRC systems. And I think we will all be very much looking forward to the day that that does actually happen, whether that be yourselves or whether it be us who have to deal with them. So that's it for me just now. I'll hand over to my colleague Andrew.
Thanks, Ryan. Can I just confirm you can hear me okay? Give me a thumbs up.
Yeah, loud and clear, Andrew.
Awesome. Apologies for being a few minutes late. Everyone, a bit of a dash across Edinburgh from a client meeting this morning. I also can't seem to get my camera to work. So unfortunately, you're going to have to make do with looking at my name while I go through these announcements. So as Ryan mentioned, I'm going to do a whistle-stop overview of the tax relief announcements. And I'm going to start with capital allowances. So that's looking at the tax relief available for your capital spend on things like plant machinery, computer hardware, those kind of things. The government announced as part of the budget that they're looking to maintain full expensing for the length of the Parliament. So that means that for most normal assets that you acquire, or main pool qualifying for any of you who are into the tax terminology, you get tax relief for 100% of the cost in the year of acquisition. Now that only applies to companies, and the assets in question or asset in question must be new and unused. They're also looking at potentially extending those generous rules to assets which are bought for leasing or hiring purposes, but I can't imagine will apply to many of you. I'm not going to spend too much time on capital allowances, but some other announcements that they include in this area include maintaining other aspects of the capital allowances regime, like the annual investment allowance limit, writing down allowances, structures, and building allowances rules. They're also, the government, really keen to simplify the tax rules relating to capital expenditure, including making clear which assets qualify for what allowances. And I would expect some further changes or clarifications to support capital investment in the years ahead. Ryan, if you could flick to the next slide. So on to innovation taxes. The first I changed on this slide relates to R&D tax relief. Ryan's also already mentioned the corporate tax roadmap, and as part of that, the government confirmed that the rates of relief available under the RDEC, or R&D expenditure credits regime, and the enhanced support available for R&D intensive SMEs under R&D tax relief will be maintained, which is really good news. It's been, I don't know how many of you listening will have claimed R&D tax relief before, but it really has been a sort of unparalleled period of change for R&D tax relief with regards to the rates of relief you can claim, the compliance requirements around claims. So it's good to see that the new government are looking for a period of stability in this regard. There's also some admin changes coming in to further support HMRC's efforts to ensure that R&D tax relief is received by only eligible companies, and also to help them in dealing with aggressive or fraudulent agents, of which there are many. With regards to R&D tax relief specifically, my advice to any company thinking about claiming is making sure you understand the rules, no matter whether you're engaging an agent or not. That submitted claim will be yours and I of HMRC, and if there's inaccuracies there or you weren't eligible, HMRC will deem that to be the fault of the claimant. I'm not trying in saying that to put you off considering a claim. I just would encourage you all to do your diligence before progressing. Also, consider the interaction of other tax reliefs such as VGTR or VJEC, which if you know in game development circumstances can be much more straightforward in terms of do I meet the gateway conditions, and actually in most circumstances now will be more generous than R&D tax relief. Um, on that note, although there's no specific announcements on the tax reliefs for video games development, there was an increase in the rate of relief available for costs incurred on UK visual effects under the audiovisual expenditure credit. Now that's for spend from 1st of January 2025. And if we look at the trajectory of travel here, we now have the independent film tax credit. We've now got the increase in relief for VFX costs. Fingers crossed, future budget announcements will include more relief for video games development companies. And I know that the team at UK are working really hard to show government the value of the UK industry, and I would hope in time that's going to translate to more support via these tax reliefs. Ryan, if you could flick over to my next slide. So now on to international tax. So one of the more interesting things in the budget announcements is that we're going to have a consultation next spring in relation to transfer pricing. The suspicion here is that they might narrow the SME exemption. So that's the thresholds which you have to apply, at which you have to apply arm's length pricing to group transactions. The suspicion is they're going to bring more groups into scope. Now, the current exemption is really helpful, especially for smaller and growing businesses that are expanding internationally. So it might mean that more companies have to consider what can sometimes be pretty complex rules. If you consider that consultation, along with the fact that much of the additional resource that HMRC announced is going to be focused on international tax, I think that suggests that they're expecting to be doing far more work in this area. So if you're part of a group, particularly those that are kind of working internationally, I would, encourage you to kind of keep an eye out on these changes and on that consultation. In addition to that, the largest multinational groups are also subject to some OECD-focused changes. So that's seeking to ensure that there's an effective tax rate of 15% in every country which these rules apply in. The UK is actually leading the charge sort of on this front with two of the three parts of these rules already in place, and the third announced to be in place from next year relating to undertaxed payments. Now that again, is going to impact a lot of companies. So, for example, UK subsidiaries of large US parented groups. And in that kind of case where you have the US parented parent, the compliance obligations may well fall on the UK subsidiary as the US hasn't implemented the rules yet. And there's also a question, I'm not going to make this political, but given the outcome of the recent US election, whether the US will ever implement those rules. So it could be that as a result of being acquired by a US parent, you as the UK company become the one who has to implement these. So again, just keep an eye out if you're part of a kind of wider group or operating internationally. Move on to have I got a global mobility one there? Yeah, perfect, right. So I'm going to talk about global mobility. So that relates to globally mobile individuals or workforces. There's a couple of announcements in this area, but I'm just going to touch on what I think is the main one. And that's from 6th of April 2025. The UK is replacing the remittance basins for nom-doms with a new residence-based foreign income gains regime. And that's the biggest change in expatriate tax for many years. There's details on the slide here that I won't go into too much in the interest of time, but the key thing is that the aim of this, or the outcome might be that it simplifies expatriate tax. It might also incentivize people coming to the UK to invest in the UK, as there won't be a kind of tax-based incentive to keep foreign income and gains offshore. So that's me, Ryan. I think we're moving on to personal tax.
Great, thanks for that, Andrew. Yeah, so I'm going to just cover a couple of quick slides on income tax. I'm conscious we've got a couple of minutes and then we can open up to questions. But income tax, like I say, is one of the main taxes that individuals will suffer, incur in their day-to-day life. So it was confirmed in the budgets that income tax rates and bands have remained frozen until 2028. Now, what does that mean? At the moment, there are three main rates in UK. If you're in England, essentially, unfortunately, and unfortunately for those in Scotland, you have many more income tax rates to be thinking about. But the interesting point is around the bands and the thresholds. So they have been held. And this is what has been labelled by the media as stealth tax, essentially. So what does that mean? Essentially, by keeping the thresholds as they are, when employees or private individuals' income increases over time with inflation and wage increases and price increases that they'll then charge to customers, it brings more and more people into the bands that will be taxed under income tax if you're at that earliest stage. But similarly, if you're already in it, then it's likely that will push you into a higher band of tax that you're then subject to pay. So that's why it's called a bit of a stealth tax, because in theory, the tax hasn't changed. It's just that because your income will naturally get bigger, it'll be subject to more tax. And as I mentioned before, the employees' next side of things hasn't changed, but the employer side has, and that was what Labour were saying that they had manifestoed as part of their pitch to the UK public. I'll cover capital gains tax. So this is one of the main areas that did change in the budget, and at the moment. Prior to the budget, the basic rate was 10% going up to 20% for higher rate. That's when you reach a certain threshold, and then gains above that will be taxed at 20%. What we learned was that from the day of the budget, that basic rate had increased from 10 to 18%, and then higher rate had gone from 20 to 24%. Now, that's to essentially line up with and those rates were already in place for those individuals who had sold residential assets, and those were already taxed at 18 and 24. So we're just aligning with that, but bringing everything into those percentages. Again, that is slightly less than what was probably touted, but I think they've done various different models at HMRC Towers and have concluded that this is what they believe is the most effective rate of tax. For people on this call, though, one of the main areas that will have impacted them is if you're a founder or you own a significant percentage of a studio. Then there was some pre-briefing about whether business asset disposal relief, or formerly known as entrepreneurs relief, was going to be disbanded, but we're pleased to see that it has remained. It had started as a £10 million lifetime limit. It's already reduced down to 1 million. That remains. So the first 1 million of gain will be across your lifetime will be under these rules, which is essentially a reduction in the rate that you're going to pay on those gains. So at the moment, and until the rest of this tax year. So most capital gains changes are immediate, like the ones above, to basically protect the housing market and so on. It has to be immediate. But on this one, they have said that it will remain for this current fiscal year. So that is a 10% flat rate. So for anyone who is already in the motions of selling shares that are qualifying under business asset disposal relief, then you will benefit from the 10%. That will then increase to 14% from the 6th of April 2025 and 18% from 6th of April 2026. You can still see that there are still benefits of doing this. It's just that next year there'll still be a 10% differential between the higher rate that you will be paying and the 14%. The business asset disposal relief will mean that you will be subject to. It will then reduce down to a 6% differential from 6th of April 2026. Investor relief, less used. It's just not really taken off to the same extent that they thought it was going to. Again, that was at 10 million, and now that lifetime limit has been brought down to 1 million, which aligns to the business asset disposal relief. And a final point, if anyone here has got any furnished holiday lets, then you will already hopefully be aware that that regime is ending and has confirmed to be ending as of next year. So it's definitely time to be thinking about putting that, putting a plan in place and making sure you understand the implications of that, so that you can benefit from business asset disposal relief if that is applicable to you. That, in a nutshell, is the main areas we want to cover. I do have 2 additional slides that were areas that have caused a lot of angst, I guess, in the media. One is around inheritance tax. Again, if you're lucky enough to be earning or have a lifetime estate of more than £1 million and then pass it on and so on, then you pay inheritance tax paid by very few people. Essentially, this is where the farmers have kicked off, and this is in the media at the moment. Whether that will change or not doesn't seem likely, but there's a lot of lobbying going on around that at the moment. If you do think that inheritance tax is relevant to you, please speak to an advisor, because it can be planned. Big changes around the pensions there. They will now form part of your estate, whereas they previously hadn't. And then just small other things that if you're looking at ISAs, then now with what have been historically very low savings interest now being a little bit higher, some people are starting now having never paid or having never paid tax on their interest that they've got. If you've got any savings, they're now paying that. So ISAs are a tax efficient way of doing that. So definitely one worthwhile using. If you've got a child in your household, there was an indication of a change to how that high income child benefit charge was being done. That's been removed. Again, similar, more interest, and VAT on school fees is another area that has been widely publicly questioned and will be coming in from 1 January 25.